JJ, the CPA here. Hope you're doing well. I want to visit with you about depreciation. Now, this is a big issue. I do cover it in my seminars. I'm going to give you a link to check out my other seminars. This is coming from that. So I'm going to pull up the PowerPoint for us to go through. I'm going to talk to you about Code Section 179, bonus depreciation, and then kind of dive a little bit into the real estate area of the depreciation, if you will. And then basically, I'm going to hope you're going to come and check out my seminar, that you'll be so excited by the information that you got here, basically for free. So let me pull up my seminar here for you real quick. So this comes from my small business tax update seminar, and I cover a number of things in here, S corps and partnerships and things for the employer, keeping you up to date on things, walking through what's going on in 22 and 23, really trying to make sure that whoever's paying attention to this, which is obviously you, that you're up to date on things. I've got ongoing seminars. Okay, there's my plug. So when we are now talking about the depreciation, when we're pulling this together, depreciation is something that you have a lot of different opportunities to take advantage of the tax law. And the reason I say that is that there's a lot of ways to go about depreciating. You can use Section 179, you can do Code Section 168, which is bonus depreciation, or you can do regular depreciation. Now with Code Section 179, this is an immediate write-off of assets in your business. So we're only talking about business here. Now, when we are talking about Code Section 179, this is going to exclude certain things, most notably related to real estate, which I'm going to get to. But with Code Section 179, there is a dollar limitation that you get in each year. So for 2022, the limitation is $1,080,000. Now, if you do put more than $2.7 million of assets into play in year 22, then you start to lose that ability to take advantage of 179. In 2023, the IRS indicated that we get up to $1,160,000 of Section 179. So again, this is 100%. Now, I do want you to note right there, as I indicate, that for those that are getting a SUV or a truck that's over 6,000 pounds GVWR, and if you're taking advantage of Code Section 179, then the maximum that you get to use for that vehicle is $27,000. That comes from Revenue Procedure 21-45. So even if you've Googled it and you found a different number, well, where you really need to go is the source. Now for 2023, it's $28,900 is your max that you get to put that in. And there's the notice that that comes for. Now, typically with my clients, we won't use Code Section 179 if we have a vehicle, a truck or an SUV that's over 6,000 pounds GVWR. And I am going to give you a link. I do have a specific video that really kind of deep dives into this. But the reasoning is with Code Section 179, first of all, it's limited. Second of all, you have to have at least 50% business usage to actually take advantage of Code Section 179 as it relates to the SUV and truck only. But with that, if it drops below the 50%, then you have to recapture that depreciation that you took previously, meaning it can be a boomerang, hit you much harder than a rubber band being pulled back and snapping you on the wrist. So really with our clients, if we do have a vehicle in the business that's an SUV or a truck over 6,000 pounds GVWR, we're taking advantage of Code Section 168, which is the bonus depreciation. Now, for 2022, it's 100%. After 2022, it starts to go down. So in 2023, it's 80%. It goes down 20% each year after that. So 80% in 23, 60% in 24, and 40% in 25, and then 20% in 26, and then it's gone after that. Now, the IRS gives us, related to real estate owners, and then I'll talk about kind of other assets as we built into here. We have really real estate that's broken into residential and commercial. So for residential, the IRS has pretty well made it clear this is if it's a residential. So if it's an Airbnb or a lake house or something that you rent out even just a few nights at a time, that's still considered residential. Commercial would be that it's deemed commercial. So with this, we know that the CARES Act had a change in it that fixed the prior law, which just means that qualified improvement property can now be over 15 years, which means that it can be eligible for Section 179 and it can be subject or available for Code Section 168 because it's less than the 20 years. Now, the one thing I want you to note is that qualified improvement property, and I've got a section back here where I go through this in quite a bit of detail in my seminar. But when you're talking about the Code Section 168 and we're applying it now to qualified improvement property, it can then only be on non-residential real estate, meaning you're not able to use the qualified improvement property tax law. You cannot take bonus depreciation if it's residential real estate. So with the qualified improvement property, also it's on the non-structural component of the building. Now, we don't get silly and think, well, is carpet a structural component? You have to think of the building, right? So when you're thinking of the building, this is non-residential, well, there's structure and there's non-structural. So non-structural, as an example, would be the interior wall, that whether that wall is there or not, that structure is still going to be standing. Elevators and escalators, those are part of the structure. But when we are then talking about what does qualify for the qualified improvement property, so it'd be the non-structural portion of the building, those components, but then only the amount allocated to that expense qualifies when it's then placed in service, and then you do the additional qualified improvement. So as an example, somebody buys a commercial building, and when they buy it, they do a cost analysis. It's not possible that any of that purchase price would be considered qualified improvement property, even though what they purchased included components that were non-structural. So if somebody buys a commercial building, then they do improvements to it, to the building, that are non-structural. That is what is qualified improvement property, and that's only what is qualified improvement property related to that. So some depreciation reminders is that when we are using and taking advantage of bonus depreciation under Code Section 168, the bonus depreciation has to be treated the same for each class, meaning whatever your assets are, the IRS has dictated to us what class they are. So typically for computers, it's 5 years, maybe 3, depending on the kind. Furniture and fixtures is 7 years, as an example. So when you then put on your depreciation schedule all the assets that you bought that year for your business, you're going to put in there them by the year classification, meaning all the assets that are 5 year, they're going to be on separate line items, but they're 5-year classed assets. So with bonus depreciation, it automatically is that asset is going to get bonus depreciation if it otherwise qualify. So you actually have to elect out, meaning for you not to take advantage of bonus depreciation, you have to elect out. How do you elect out? You just simply don't take it. But if you elect out of one new asset, and it can be new or used to you, but I just mean, in essence, new to the business, excuse me, then if you do elect out of bonus depreciation on one 5-year asset that you're placing in service for the year, well, then you have to elect out for all 5-year assets that you've placed in service that year. Now, with Section 179, you can elect this to be applied to any asset. So if you bought 3 computers, on one computer, you could do 179 and not on the other 2 computers. But the thing is that if you're going to do bonus depreciation, it would be either on all 3 computers or not. Again, let's be clear. We're not talking about if you now have assets that you bought in prior years for your business that somehow they're affected related to bonus depreciation in the next year. We're talking about assets that are placed in service that year. Now, for residential real estate owners, I've got a nice breakout. I would probably just recommend, if you're interested in this, go ahead and take a screenshot here. Just hit pause and screenshot it. But I've verified this over and over and routinely with the IRS. But with residential real estate, this is then the class life. You don't get to depreciate land, but with residential, for the structure, whether it's non-structural portion or the actual structure, That's over 27 and a half years, including the roof, the HVAC, security system, and alarm system. Those can only be then depreciated over that life. If you've heard something else, you heard wrong. Whoever told it to you is just wrong. I'm going to give you a link here to the IRS publication for depreciation. This is where it all comes from. So it kind of doesn't matter what you heard, what you were told, what you've done. You got to go to the publication because that's where this is from. And the other reason I'm bringing this up is that many think with a roof or an HVAC security system or alarm system, you can use a different method, but on residential rental, you simply can't. It would only be on commercial that you could. Now, for land improvements, that would be sidewalks, driveways, and parking lots. Those can be then over 15 years. Initial landscaping, grass, shrubs, trees, also over 15 years. Flooring, carpet, things that are not the foundation, and then really your built-ins, fixtures, lighting, things that you could take with you. That's the class life. And then you can do 100% bonus depreciation on those because these are assets that are less than 20 years. You cannot use Section 179 on any of these things that would otherwise qualify because real estate by default is not considered a quote unquote trade or business. Now, if you're a real estate professional, then that could be available to you to take advantage of Code Section 179, but it would only be on those things listed here that are 15-year, 10, or 7-year. Now, when we're talking about commercial real estate owners, this is where you can really kind of do this because while it does not benefit you in the long run on the aspect of the building that's the structure because it's depreciated over 39 years, well, with commercial real estate, you can take advantage of Code Section 179, meaning an immediate deduction, and you can take advantage of the Section 179 on things that are still 39-year, and then you can also do bonus, and then you have some that you can do the bonus or over the life or Section 179. So when you're talking about a commercial real estate, what I want you to remember is what I told you earlier. Commercial real estate is where a commercial business is. You can't have a residential piece of property and then quote unquote deem it commercial unless it gets zoned as commercial. So if you have something that happens to be zoned as either or, then it would then go to the use of it. So with that being said, when you're now looking at the building, the non-structure, the qualified improvement property that's been placed in service after the property was bought, that's over 15 years, and you can do 100% write-off in 2022. In 2023, it would be 80%, so on and so forth. Or you can do it over the 15 years, or you can elect Section 179 up to that limitation. Then for the roof, the HVAC, the security system, the alarm system, I get you. You might be scratching your head, especially fellow tax pros, and you say, whoa, you can't do Section 179 on those things. Well, you can. The PATH Act survived TCJA, so you can do Section 179 on these. If you don't do Section 179, it's not available for bonus depreciation because it's over 20 years, and therefore it doesn't qualify for bonus. So if you don't do Section 179, then you would do it over the 39-year. Now, for commercial real estate, sidewalks, driveways, parking lots, you get the 100% bonus or life. These are not available on 179. Same thing with the initial landscaping, grass. So you can either do it on those class life, or you can do the 100%. Again, 100% is for 2022. So if you happen to be watching this in 2023, then in 2023, it's 80%, as I told you in a previous slide. Now for flooring and carpet, again, that's 10-year built-ins, fixtures, lighting, things that you really could take with you. You also can do the bonus Section 179 or over that class life. So when you are talking about commercial buildings on the non-structural component versus the qualified improvement property, so you can have non-structural, that's a component of what you bought, but it wouldn't be qualified improvement property because, as the word basically implies, it's not improvement to the property after you bought it if it's non-structural that was a part of the building when you bought it. It's okay if your head spins on that. Again, I just want you to remember this. When you buy a commercial piece of real estate, when you do your cost analysis and you break it out into these class life that we indicated here, basically any non-structural portion is going to be over 39-year. You won't be able to do Section 179 or bonus depreciation on it. Now, if you bought the commercial real estate and then you are now going to do some improvements to it, then the non-structural improvements to it can be over 15 years in bonus. Now, if you buy commercial real estate and you're putting in new bathroom fixtures and new lighting, well, then you're going to just be able to take advantage of either the 10-year, the 7-year life and get Section 179 or bonus or life. So when we are talking about the non-structural components here, we're talking about the actual part of the building. Now, if you are getting into where you're building commercial real estate, I give some information in my seminar here, and I'm sure some of you might be savvy enough to go ahead and do a screenshot. That's fine. I'll let you. And on your screenshot, you could copy and paste and go to these PDFs. But I'm going to save you the trouble. I'll just give you links to these that I've indicated here. But with this, what you want to be keeping in mind is that if you are building the property, what really comes in key here is, well, what is the date in which you placed it in service? Because the improvements that are non-structural to the commercial real estate that you placed in service after it was placed in service, you're right, I said it both times, then that gets to be under the 15-year available for bonus depreciation or Section 178 or life. So as a private letter ruling with the IRS, that when somebody builds their home, commercial real estate, okay, I didn't mean to say home, when they build commercial real estate. So there's a couple of key components, and it kind of works on how you work it out with your general contractor. But when we are talking about this aspect of you building, then the key component of when you placed it in service initially is several. It could be when you have a temporary permit of occupancy. And so I know I moved into a building once and we were able to move in, but there was still a number of things that still needed to get done in portions of the building. So it was safe because we got the temporary permit of occupancy, but then that would be the date it was placed in service. Now, that's not the only possibility. The other possibility is this. If you have tenants, which could include yourself, but if you have a tenant and they sign a lease, then on the date the lease is signed, at least for that area of the commercial real estate, then that has been deemed placed in service. So you could have bought some commercial real estate and it's dirt. You sign a lease, and let's just use a simple example. It's commercial real estate. You got 4 areas to it. So let's just use a strip mall kind of as an example. And if strip mall means something different in your part of the country, I'm talking about where you drive up and you see all the front doors and there's the pizza place, the nail salon, the liquor store, and the dry cleaners, right? So you can have dirt. You've got the plan together, but you're savvy enough that you've had people sign leases with you, and now you're going to build the building and then build it to suit. Well, the fact of the matter is, because you had the lease in play, then you've placed it in service, which means this. It doesn't change the fact that whatever you're now going to build that's structural is still 39-year, and it's going to be 39-year. But then anything that's non-structural components of the building, well, then that can be a qualified improvement property because it was expenditures. It was done after it was placed in service. So signing of the lease is the initial date that it was placed in service, and then improvements after that to the area in which relates to the person that signed that lease, meaning their area of the building, then would be able to take advantage of the qualified improvement property. Now, if you have something and you say, well, I've got 3 of them leased and I don't have one of them, well, I might suggest to you then we'll work on the first 3 areas and then get a lease for the 4th where you start really working on that when I'm talking about the non-structural components. So again, non-structural components would not be carpet because it's not part of the building. When I'm talking about structural components and non-structural components, this would be what you can't take with you, right? So an interior wall that's, solid, maybe has a door in it, drywall, whatever it is, right? You can't take that with you. But if it's a wall that is not holding up the building, then that's non-structural. And therefore, it is, if that expense was after the property was placed in service, well, then it could be something that's qualified improvement property. So just as a quick recap on the commercial property as it relates to the qualified improvement property, it is only after you place it in service. So the first is, if you're buying an existing commercial piece of real estate, well, then when you buy it, that's your date placed in service. So any improvements after that that are non-structural qualify as qualified improvement property over 15 year that you can do bonus depreciation, Section 179, or over the life of 15 years. Now, if you buy dirt, I think I gave you a pretty good example there. Well, it's not placed in service until you have a temporary permit of occupancy, assuming you haven't leased it out. And it's not placed in not placed in service until you have a lease signed for then that area, then any of those expenses. So really what it comes down to is what's key here is you do want to be mindful of what is the date that it was placed in service, because that is key. So working with your contractor, working with the city to get the permit of occupancy at the key time can make all the difference, because again, you aren't able to get that bonus, that immediate depreciation, whether it's 22 at 100% or next year at 80% in 2023 or 20% going down after that, unless it qualifies for that. So you want to be really mindful of all that. Well, hey, I hope that was helpful for you. I'm going to put a link in the body of this video for you of the things I indicated to you. I'm also going to give you a link to the seminars to check out. Hopefully you got some good information out of this that you may want to check out my other seminars. I got them on the individuals and the ERTC and for small business and tax planning. So if you're not a subscriber and you made it to here, holy moly, how are you not clicking right now to be a subscriber? All right. Hey, thanks for tuning in. I'd love it if you'd subscribe. Oh, wait a second. Check out this video right here on the LLC setup related to real estate. Check this one out here on the ultimate. And then I think I got a playlist. Yep, playlist is going right there for you. Don't you ever forget, you've never met a CPA quite like me. Have a great one.